Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, I'm once again joined with my good friend, Doug Heagren. Hey, Doug.
Good morning, Kirk. How are you today?
I'm doing well. Just got back from vacation. I'm all nice and refreshed and wishing I was back on the beach.
Oh, I can imagine. Where'd you go again?
I went down to the Cape, which, I just realized somebody else said, well, no, there's a Cape near us, Cape May. I'm like, no, that's not the Cape.
No,
I'm from Massachusetts. It's the Cape, just
that's
like
right.
the country club.
Well, that's right. It's like Adele, right? You only need a name and everybody knows who you're talking about, unless this person is near a different Cape and thinks it's the Adele. But anyway,
Yes,
continue
that's our Massachusetts for us, always thinking they're the only one.
Right.
All right, well, let's just dive right in this week. So so getting right at it. So this is a lot this week. We had a whole bunch of stuff. We had Joe Biden telling everyone he's going to forgive student debt. We had a market rally, a bull market, a bear market rally. We had all sorts of stuff. So let's just dive right in. I'm gonna start with this this one image here, Doug, and I want you to kind of play along because I know you've seen this. There's an image that's got four boxes. It's going to show up on your screen right now for those of you watching on YouTube. If you're not, please do, because you're going to get more of the visuals here. One side of this is the bear argument. One side of this is the bull argument. Now, I put this up here because I think what's important to recognize is no matter what the market is showing you, there's always an argument for the other side. There's a bullish argument at any point in time, and there's a bearish argument at any point in time. Now, this is a technical analysis. This isn't even fundamentals. We're not even talking about what things are worth, practically speaking. This is just people looking at charts and saying, all right, this is what the future is going to hold. Now, you'd think, well, technical analysts, they're pretty good. They can predict the future movements of stocks. Well, that's actually not true. They're really good at analyzing which way it could go, and they base their decisions on probabilities and expectations of where things could go. But they don't expect it to go in any direction. But this is actually something that they do use to look at future movements of stocks. So for the bull case, they're looking at an overlay of a different time period. They're looking at 1962 compared to 2022. Why are they doing that? Well, they think for some reason or another, there's a correlation to that time period. And oh, look, the chart happens to mirror it rather well. Okay, that's one example. They also look at 2015. That's another bullish case. Well, look at that. It's mimicking it very much. And both of those charts basically say, hey, we're going to have a little sideways movement, and then things are going to go back to normal. That's the bullish case. Okay. And they even have correlations. What's the correlation up to this point? 90%, 86%. Those are pretty strong in terms of how correlations go. Now let's look at the bearish case. And the top bearish case is 2008 compared to 2022. 91% correlation. Basically what that shows is, yeah, things were doing well and then they fell off. Maybe they'll bounce a little bit and then they're going to get really ugly. I think everyone here remembers 2008. If you didn't, you should, because it's going to hurt if that happens. Then the one below it, which is an 85% correlation, which is 1973. I think 1973 is probably a more realistic one because it tends to follow along with, my thesis in terms of where I think things are going. And a lot of that has to do with inflation. So if you take 1962, it's not quite the same era. You take 2015, not quite the same era. 2008, not the same era. So if you look at all of those have certain things in common. I think 1973 has the most in common because it was going from a period of lower inflation into rising inflation, which is similar to what we have now. So just from a charting perspective, yes, all four of those have enough correlation where it makes sense to consider them. But I think you have to consider the big picture of what's going on with inflation, which we're going to talk about in a second with Doug. But I wanted to point that out because I think it's a really important chart. You're going to see these all the time. And I put all the four of these together because you're never going to see them all together. You're only going to see one, and it's going to be very convincing. Oh, look, it's mirroring what this other thing's going to do. And when you put it in context of other points in history, you realize, okay, well, you can make an argument both ways, right? And so I think that's the important takeaway here is that no matter what you see, there's another side to the story. And just because you didn't see it, it doesn't mean it's not valid. So what are your thoughts, Doug?
Well, first of all, Kirk, I'm going to have to scold you on this. How dare How dare you look at these charts and then use something called fundamentals with it? I mean, this say 1973 chart looks right. No, now you're starting to get into like fundamentals. That's not what this is about. We're talking about chart analysis here. We're talking about just looking at where the graph's going. And no, I kid you, but this is one of the challenges that you run into with any kind of directional advice that you may hear from whatever talking head you listen to. And it's just like politics, right? People, these analysts, they get caught in their own vacuum chamber of what they want to say, what they want to believe, and you get confirmation bias, right? And you can find whatever you want to see in those charts. In some ways, it's kind of like the old Rorschach ink blot test, right? It's like you throw those details up there, and then what does this person's psychology see in it? What does this person's psychology see in it? I think the biggest takeaway, and I think you nailed it, is it can be viewed both ways. And the issue is going to, and this is why you hear about people being called perma bears or perma bulls, right? They're always looking for the things that confirm what they believe, and they build a brand about this. And some people get wrongfully accused of being a perma bear or a perma bull. But the reality is that if you are looking for negative data, you're going to find it. If you're looking for positive data, you're going to find it, all with the same ink blot. And I think that one thing that infuriates me is when we look at this kind of information and we start to, and you start to hear these terms out there that people throw out like, hey, that's already been priced in. Really? Okay. What tells you that it's been priced in? Well, you're looking for data that says, see, it's already negative or it's already positive. But if that were the case, that would mean that the markets wouldn't change anytime that data comes out. And let's face it, Kirk, that doesn't happen very often, right? So I think if you hear it's been priced in, if you hear it's going this direction, you really need to take that as a grain of salt. And I think gonna have to go back and maybe listen to Kirk a little and say, maybe the fundamentals need to come into play here as well, not just the charts and graphs.
Yeah, no, I appreciate that response there, Doug. I want to point something out you made about the perma bears. For those of you who've been around long enough, you probably remember Dr. Doom, Nouriel Roubini, who they trucked out in around 2008, and he was talking about all this negative stuff that was going to happen, the world's going to end. He wasn't wrong in many ways, but the guy got to be a bit of a celebrity. He heard about the wild parties he'd throw in New York, and he was a celebrity because everyone knew who he was. He was just a professor. Smart guy. I don't mean to demean him, but he was considered Dr. Doom. That's what everybody called him. And he was Dr. Doom till about 2012. Then they kind of like shuffled him away because, hey, everything's bullish again. And then, and then I saw a story, I don't know, maybe a few months ago that talked about Nouriel Roubini, Dr. Doom. And I was like, oh, must be a bear market again. They're wheeling them out for the masses to scare the crap out of everybody. But one thing you mentioned here, I do want to touch on is, and we'll show you the chart here, the Fed funds futures curve. And we bring this out because what this is here to show is that based on this, now I'll explain what it is and I'll explain what it's explaining. So the Fed funds futures curve basically is a prediction of what the market thinks is going to happen at different points in time in the future. So as of now, the Fed funds rate is, well, on this, I think it's, 1.6. But if you go into January of 2023, it might be about 3.15, I think. I'm sorry, 3.65 is approximately where it is. Now, obviously, that's going to change. And if you see the other line here, the blue line is now, the red line is 1 week ago. And as you see, things have changed in that week. Now, what this is showing you is that around January, people are expecting the Fed to stop raising rates. That is what the market is expecting. That is what this chart shows. You don't need to know all about Fed funds rates and futures curves or any of that. What you need to see is at January 2023, the market thinks after that point, the Fed is going to start to loosen their policy and lower rates. Okay, that's what the market is expecting based on this. So we talk about future expectations. This is what the market is expecting in the future. They are expecting that by the end of the year, the raising of rates will stop. I do not predict that. I think that is very pie in the sky thinking, because Powell has come out, not to say that I totally believe Powell at any point in time, but I think I would agree that this is the direction he needs to go, is rates need to keep going higher. And I don't think we're going to be in a recession, well, except for the recession that Biden denied a few weeks ago. We're not going to be in a recession where we all feel it like a recession, right? You can technically be in a recession and not feel it for a while. I think we're not going to quote unquote feel it for another 6 months. I think that's when it's going to start to hit with the unemployment rate and all the other things that matter. That's going to be apparent. So if that happens in January, then yeah, they might loosen policy. Right now, the economy is not showing that. So they're going to have to be a lot firmer in their wording. They're going to have to raise rates at a faster pace. All these things they need to do. And, you know, as we talked about in other weeks with the bullwhip effect, it's hard to predict, right? You could raise hard and then the economy softens and then you soften, then the inflation takes off again. That's the bullwhip effect. It's going to happen. And it shouldn't be a surprise to anybody that we're going to have these ups and downs through this period because we've been talking about it for the last few months. And you should continue to expect it. But the lesson I want to take away from here is with this Fed fund futures curve, this is the future expectations that the markets hold. And so when you're thinking about, oh, well, you know, the market has already priced that in. This is what they've priced in. So if you want to see what the market's priced in, this is it. This is why the futures markets can be really helpful in understanding what the market thinks, because it's pricing in what they think the future is going to be. It's not always accurate, right? It's directionally accurate, but it's not 100% accurate. So don't assume that this is what's going to happen, because as you've seen in 1 week, that can change dramatically just by, and this isn't even including last week with Powell's talk on Friday, where he was a little bit more, you know, harsh on the markets and saying, "Oh, we're going to keep going full steam ahead." I think that's going to alter this. And every time he makes a statement or another, anybody else in the Federal Reserve makes a statement, this is going to change. But you should know this is an indicator that you should look at and say, all right, this is what is actually priced in. Now, if you looked at this 6 months ago, you would not see the same pricing. You would not see it at all. This would have been a lot lower. So as this continues to rise, that will start to affect the market more. So what are your thoughts, Doug?
Well, I think what makes this unique, and I think you just talked about it, it's what's Powell going to decide, him and the rest of the Federal Reserve. This is very different than 2008. 2008 was a situation in which the economy eroded rapidly, right? When we all of a sudden had an implosion of creditworthiness, and the Federal Reserve reacted to that by doing some things through quantitative easing to try to fix and create money supply that would allow for the ability for the economy to sustain itself, to make liquidity available. That's not the case in this time. This time, the economy, you know, the government did give the money supply because of COVID, and that's where we had massive money supply. We've talked about this ad nauseum, but we've seen that money. We've talked about how that money supply needs to get reabsorbed. And we've started to see that. There's some things out there around 50-60% of that money supply has started to absorb. But this is where you get into some who has and has not, right? The money supply that's out there, those that have it right now are not feeling the pinch yet, okay? But we are starting, we can certainly talk about this now or another time, but we're starting to see at the bottom tier that pinch of money supply having an effect. People are starting to see, you're starting to see credit card rates, balances go up. We're starting to see some defaults starting to happen, or people get behind on things. But the problem is there's so much money out there, trillions of dollars that's still out there, that this time the Fed is being proactive. Now, some would argue it's still too late proactive, but they're being proactive in trying to suppress this money supply very quickly, rapidly reabsorb it by not putting more out there. What's the issue with that? The issue is that is now, instead of the economy going naturally eroding on its own, we are left to an economy that rapidly erodes based on whatever comes out of their mouth. And that's the challenge you run into. What's Powell going to say next quarter? What's he going to say the quarter after that? You can, and honestly, he may not even know exactly what he's going to say, because they're trying to read the tea leaves and make these decisions, which leaves a lot of a lot of room for speculation and a lot of uncertainty on the table that with just like what happened on Friday, all it takes is we thought things were going to get better. He says, look, we're now going to go, he was talking soft landing, soft landing. Now he's speaking a much harder tone of hard landing. Why? Because again, at the top of the money spectrum, there's still too much going on with the bullwhip effect. There's too much liquidity out there to reabsorb. It's still not slowing things down enough. Inflation is still a problem. And, next quarter, he could come back and start talking soft landing again, or he could continue the hard landing rhetoric. And that's what makes it challenging right now to make any predictions whatsoever. And you're going to have to be nimble.
Yeah, I couldn't agree more. So I want to touch on some next topics here. I want to poke a little fun at my my Bitcoin followers here, my cryptocurrency followers. Hopefully they don't unsubscribe to the show by this, but I have this nice chart here on YouTube. Bitcoin versus avocados in terms of an inflation hedge. We had a nice debate last year, gold versus Bitcoin debate on our show, as well as we had at Freedom Fest. And I made a prediction that gold would outperform Bitcoin in the next year. Of course, we won that. But I think this is funny because avocados have been a great hedge against inflation, and Bitcoin is not. So hopefully you can all take a good joke. Next, I want to get into housing, because I think housing here. And by the way, I want to give Doug credit for this chart because it's hilarious.
If I can just add one thing to that,
ahead.
Kirk, really quickly. If avocados have been a good hedge against inflation, then what's that mean for lettuce? Because as we talked about in one of the last conversations, in Australia, avocados have plummeted to 1/10 the price of lettuce because of oversupply. So right now, stock up on iceberg.
I'm not sure that's a good substitution in economic terms, but anyway. All right, so let's roll into the next area. So I want to get into housing because I think this is really important. Doug sent me some great pictures here on housing. And so there's a few of them here. So like I said, once again, YouTube is going to benefit from this. So please watch this on YouTube. But monthly supply of new houses in the U.S. Have hit a near-term peak, and unprecedented surge in homebuyer mortgage payments have skyrocketed. So this is one of the things that we talked about before, and it's really important to understand, is that housing is really interest rate sensitive. And we have not had an issue with this for the last 20 years because we've had low interest rates or declining interest rates, and people have just gotten acclimated to how easy it is. But now interest rates are climbing. It's a lot more expensive for new home buyers. And if you're buying a home, you might want to buy it now instead of later, because later it's going to get even more expensive. If you think about the example I gave in the past, the 2% 30-year mortgage for a $700,000 mortgage is $2,500 a month. At 7.5, it goes to $5,000 a month. Right now we're at 5.5, and it's not a stretch to say we could go to 10. I'm not saying it's going to happen tomorrow, but I think at some point we're going to hit at least 10 over the next few years. So what that means is house prices are going to decline and mortgage interest payments are going to skyrocket, as this chart here shows. Before 2022 is right around $1,700 a month, and it shot up to $2,450. That's a huge problem. And, so it really puts into context, if you're buying a new home, is this something you want to do, right? Do you want to move, or do you want to wait this out? And if you wait it out, how long is that going to be? Right? I mean, it's not going to last forever, but certainly it could last another 5-10 years. I mean, you have to put that in the back of your mind, because we don't know. I don't know any more than Doug or right? Because we can't predict the future. But I think if you look at history as a guide, the 70s period lasted a little bit over 10 years, where inflation was a problem. So maybe that speeds up because information and all that, or maybe it's the same. Maybe it ends up lasting about 10 to 15 years. Who knows? But I think the point is just keep it in the back of your mind that if you're going to be buying a house in the next 5 years, be really careful about the decisions you make. And at the end of the day, if you're just changing, if you're upgrading from one house to another, at the end of the day, it's probably going to matter a lot less because you're just selling one and buying another. So it's going to be a bit of a wash. But if you're fortunate enough to be renting, be patient, because I think you're going to see house prices come into your range where you can not only afford it, but it's actually realistic compared to what they were in the last few years. So what are your thoughts on housing, Doug? I know you have quite a few.
Well, so my thoughts, I mean, I'm seeing it in my neighborhood. We saw a house that went for sale 6 months ago, sold first weekend, multiple bidders, $1.1 million house. Another house just went on the market and kind of used that as their pricing metric, and some slight differences in kind of where the house was located, but they came out at about 1,080,000, and now that house has just already had to drop their price down to close to 900. Okay. And I mean, that's just in a couple of months. I know that you were talking about, what if it goes to 10%? So, if we use 5% as the rate, and you look at that 20, that chart, I mean, you're looking at basically an average home price of $450,000 based off of that. So if that's the case, it's around $2,400. If we go to 10%, a $2,400 mortgage goes to $3,900. That is an extra $1,500 a month. And here's what I'm going to say about it. I've been beating the desk on this forever. And I feel like the last industry that ever understands real estate is real estate, right? It's like, well, it's a supply and demand issue, right? Prices are going to keep going up. I always find shocked how mortgage lenders and realtors seem to be the last ones to recognize what actually happens in the economy. This is a money supply issue, okay? It's very simple. Been saying it for years. It is a supply and demand. No question people need homes, but there's an affordability that comes from it. And ultimately, who determines the real estate market? It's the banks, okay? The banks ultimately, for the majority of America, have to give you the money in order to purchase. And so if you're out there and you're trying to buy a home, and the interest rates are 2-3%, and the cash, on a 2 to 3% loan, let's just go back to 3%, you're looking at an $1,800 a month payment. There's a lot of people in America that can make a payment on $1,800 a month. Okay. So all of a sudden, yes, it is supply and demand, because look what you've done to the supply of buyers. They're coming out of the woodwork, right? Everybody can afford a $450,000 home. Not everybody, but for the purpose that you understand. Okay. So the bank is going to be very apt to give most of these people a loan. Say, hey, yeah, you know what? $450,000, $1,800 a month. It comes down to your income, right? It doesn't matter if you have $2 million sitting around, it comes down to your income. That's what they look at predominantly. And so $1,800 a month, sure, there's affordability, ratio of income, great. All of a sudden it jumps to 5. You go up to $2,400 a month. Okay. So if you go from 3 to 5, you just increased it by about $600 a month. You just took a few people out of that equation. Demand just dropped. It's not a change in the supply of homes, but the demand just dropped. Now you get up to 6%, and all of a sudden now you're looking at somewhere in the range of like $2,300 a month more. I'm sorry, $1,300 a month more than we were before at a 3%. Again, the banks are going to sit there and start going, look, you don't have the income. You don't have the finances for us to feel comfortable lending to you. You start cutting out tiers and tiers and tiers of people. And guess what? Naturally, all of a sudden, you're going to have prices come down. Simple supply and demand. But so many times, this is an argument that's made on supply side. And yes, that does happen. But we've also been building homes left and right over the last couple of years when the demand was there. You spike that demand, the supply side, but then the fastest thing to turn is demand side. And that's what happens generally with real estate, is all of a sudden demand side gets obliterated in these interest rate conversations. And it's not going anywhere fast, because the federal government has said, look, we're not going to back these banks through our Fannie and Freddie programs. We are tightening up. And if that means that we're not going to back the banks don't have the security with their high reserves to lend. Wells Fargo is getting out of the mortgage lending industry. We're already seeing mortgage lenders die on the vine left and right. And so if they're not going to give the money, then all of a sudden supply is going to shrink rapidly. And I don't see this ending anytime soon.
I live in the great state of Massachusetts. I may be the only one who calls it that, but I digress. The great state of Massachusetts has a commercial funded by the state that says, you can't win the lottery if you don't play. For the moment, let's ignore the fact that there's a state-sponsored commercial suggesting that you go out and spend your hard-earned money gambling on lottery tickets with odds of over 100 million to 1 of winning. But it's true, you can't win if you don't play. I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. I'm only asking 5 to 10 minutes of your time. But I will pay you at least 100 million Zim dollars for your time. We do have some foreign listeners, so if you don't like Zim dollars, we may have some other currencies as well. If you want to earn over 100 million Zim dollars, go to www.moneytreepodcast.com/free money to get your free money today. Yeah, I agree completely. I think the way to think about real estate is hard because I would say for the last 10 years, I had this open question in my mind of what is it that's going to topple real estate? Because it was just going up so much, well beyond what's reasonable. I mean, people used to expect 10 to 12% on a rental. Now they're taking 2 to 3. I mean, there's no accommodation for the risk you're taking. So, I think for a lot of smart people who were good real estate investors, it just priced them out of the market because they're unwilling to take a risk on real estate for 2 to 3%. And what I found interesting is the supply and demand issue has always been one of those things that is talked about, and it's not just by realtors; it's talked about by investment professionals in Wall Street, and they talk about it. Well, it's supply and demand. There's not enough supply, so it's going to keep going up, and it's almost like this magical thinking kind of a comment, like, oh, well, it's obviously supply and demand, so there's not enough supply. There's more people. We'll be fine. But I don't think I've ever heard more than one time. I think it was one person I've ever heard say it comes down to affordability. And when I heard that, I was like, that makes so much sense. Because if you can only afford a certain amount, then no one's going to buy it, right? I mean, if my payment, if I'm buying, let's say that property for that 700,000, if I'm buying that property and all I can afford is $2,500 a month, then I can no longer afford that property. Now I can afford a property worth half that, or at least a mortgage worth half that for the same thing. And then if rates go up past 7.5, they go to 10 or 12, that's going to be less than there. So I think what it comes down to a lot, especially for residential, primarily for residential, is affordability. And, we're not talking about big hedge funds and pension funds that are buying, huge commercial properties. That's a different space. They're similar, but certainly different. Everyone buys on affordability because you can't afford it. It doesn't matter what the demand is. I can't afford it, which means that they can only pay what we can pay. And so I think ultimately it comes down. So you have these two factors that come into play. And I also want to overlay inflation because I think this isn't said enough, but if you look back historically over 100 plus years, real estate is a great hedge against inflation. Always has been, always will be, right? For many reasons. However, the problem with that is that it's good over 100 or hundreds of years. It's not good in a 1 or 2 year basis. In any given year, it can change, right? If you look at Japan, Japan has had deflation for the last 30 years, and real estate prices have declined for a majority of that time too, right? And, granted, their population is not growing, but it shouldn't be shrinking to that degree. So there's multiple different factors that come in. Inflation's really important. I would argue that I think even avocados are going to outprice real estate in the next year. As I just think that what Doug and I are talking about is so strong that it's going to continue to push home prices down. And so if you own a home and you're not going to sell, I'm always going to put this caveat out there, is that if you own a home and you're not looking to sell, none of this matters to you. Don't get scared. Don't sell your house because you think the world's going to end. You own your home. You have a mortgage payment. Your payment is your payment. That's not going to change as long as it's a fixed payment. If it's variable, you might have some trouble. But as long as it's fixed, you know what you're going to get. It doesn't matter what your house is worth. Because at the end of the day, it's a personal expense. It's not an investment. I've been saying this for years, and people argue with me all the time. Your home is not an investment. It's a personal expense. And if you want to do it, that's great. This is not a judgment. But if you look at it as an investment, you're going to be sorely disappointed. Because what if real estate prices drop 50% from here? Well, it's not a good investment, is it? So why are you looking at it as an investment? Because you're not going to be happy with the outcome. It doesn't matter because you're living there. You're enjoying the house. That's what matters. You're buying it, whether you're renting or you're buying, you're paying a certain amount of money to live somewhere. And as long as you're happy with that location and you can afford the payments, then you're in a good place. But for those of you who are looking to move in the next few years, you really need to be on the ball. You might need to accelerate your decisions forward a few years and try to do it now, or maybe even rent if that's the position you're in. I have no problem telling people like we're renting because I see the opportunity ahead in the next few years and I don't want to be an owner. I'd rather rent and then buy when the opportunity comes up. And I'm sure there'll be tons of opportunities. So, I know that's a little bit more of an aggressive approach and I don't recommend it to everybody. But if you're on that line and you're trying to make a decision, that's the way I would lean. So I know we're kind of wrapping it up here, Doug, but final thoughts from you, Doug.
Yeah, just a couple details I wanted to add on that. So I was looking at, so if you take a look at 3% mortgage on a $450,000 home, you're looking at about $1,800 a month. Comparably, if interest rates rise to 10%, to still pay $1,800 a month, you would only be able to have $215,000. If that's not going to put pressure on real estate, I don't know what else is, because anybody who could afford $1,800 before is now only going to be able to get approved from the bank. They control this to be able to go out and borrow $215,000, not $450 anymore. And so there's supply side and there's demand side, right? Supply side is the available homes. Demand side is how many people can buy it. It's going to be pressure on both because there's so many people locked into 3% homes that unless they have to, they're no longer going to push that supply out there. At the same time, the banks aren't going to allow for the liquidity to be able to buy homes at those prices, so the demand side drops as well. It is unprecedented, the level of pressure that we may see on both supply and demand side, and how that may balance out. The other thing I wanted to kind of circle back on just really quickly is, as you mentioned, homes, let's not look at it as buying a home. You're buying housing. Housing never ends. Okay, your mortgage might end, but housing never goes away. And renting and home and mortgage is essentially the same thing. You are paying someone to give you the right to have a place to sleep. This is not investment real estate. Okay, so if you are inclined, again, over the next couple of years, we don't know what's going to happen, but a majority of Americans' wealth is tied up in real estate, and a lot of their wealth is tied up in their residential real estate. Okay, and they bank on this as part of their feeling of the prosperity of their future. But the biggest issue, one of the biggest stressors that in financially that happens, is lack of access to capital. If your biggest wealth is the equity in your home, you have to ask yourself right now over the next couple of years, how are you going to get that? There's only two ways to get equity out of your home, and that's to sell your home or to borrow against it. Now, we've already identified that borrowing against it may be hard to do and more expensive. And if you're not planning to sell, one thing I would be very cautious about doing is I'd be very cautious about if you are planning on putting extra payments in your home right now, because you may not be able to get that back out if you need it. This is a really important time to maybe plan around building up liquidity or putting money in a side account, because I'll give you an example. The greater inflation is, the better your house payment becomes. Okay, so if we have normal inflation of 3% and you have a $2,000 house payment, in 1 year, that house payment will only feel like 1941. But if we go out, let's just say 15 years, because a lot of people like have a 15-year mortgage, or 30. A $2,000 payment at 3% 15 years from now is only going to feel like $1,200 a month. Okay, because it's a fixed payment, it is one of the few payments that, compared to everything else, is going to go down. But we're not in a 3% environment right now. We've already talked about inflation's here, and it may be here to last. So let's just say we continue to get a 6% inflation. If we do, your payment a year from now, if you have a $2,000 house payment, will only feel like $1,886. And 15 years from now, that payment is going to feel like less than half, only $834. And ultimately, 30 years from now, it's only going to feel like $350. So the rush to pay off your house as quickly as possible, not only maybe trapping your liquidity and capital, but it's actually throwing the most valuable money you have today away at something that is going to cost you less and less and less over time. This is the truth about money. It's math and science, and it's important for you to know, because that's where, hey, If my payment's going to keep going down, where can I put my money to make it go up and still be liquid? This is an important conversation to have with your financial planner.
Absolutely, Doug. So, Doug, where can people find more about you?
Thanks, Kirk. You can find more about me at www.mergentgroup.com. That's MERGENT group.com. Also, co-owner of Entracraft.net and ProCollegePlanners.com. If you are a business owner with revenues between $1 and $30 million, and you're trying to look at a better work-life balance and have better valuation of your company, as well as have a company that's just built to work without you, then take a look at us at Entracraft.com. Additionally, if you have kids that are going to college in the next 4 years, college is expensive. It's a game, and the game has worked against you. Help even the score. Look us up at ProCollegePlanners.com.
Great. Well, thanks again for coming on, Doug. And next week, we're going to touch on college a little bit, because there's some news out there about the forgiveness of college loans. And that's a huge piece of news, which we're going to touch on next week. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.